Start. Yeah, like.
Happy evening to all our professional colleagues. On behalf of SIRC of ICAI, I welcome you all to today's session on presentation of financial statements by non-corporate entities and a new format of financial statements for NCEs. As you all are aware that financial statements of an entity provides useful information in a wide range of users and help them in making decisions about an entity. And this is very essential. The financial reporting of an entity should be comparable, transparent, complete, and unbiased. So our ICAI has issued a technical guide on financial statements of non-corporate entities to ensure consistent and effective application of the accounting standards for strengthening and standardizing the financial reporting system of these entities. ICAI has also prescribed a scheme for classification of the non-corporate entities into 4 levels, that is level 1, level 2, and level 3, and level 4. And ICAI also provided a technical guide on financial statements of non-corporate entities that provides the recommended formats of financial statements applicable for non-corporate entities. So to throw a light on this topic, we have with us an eminent speaker, CA Mohan Lavi from Bangalore. Sir, we wholeheartedly welcome you to today's seminar, sir.
Thank you, ma'am. Thank you very much.
Before handing over the session to our speaker, I would like to briefly introduce him. Mr. CA Mohan Lavi is a qualified chartered accountant, and he has qualified in the year 1989, and he has over 25 years of experience in industry across a variety of industries. He has worked in senior positions in finance, in manufacturing, and software companies. Mohan has also over 6 years of experience in practice. At present, he is a partner with Mrs. KP Rao & Co, Chartered Accountants Bangalore, and heads the Ind AS and GST practices of the firm. Mohan is the author of books on IFRS, Ind AS, key audit matters, and other related topics. He has spoken at various conferences in India and abroad on accounting standards, IFRS, Ind AS, and SOX and GST. And he is also a faculty member with the Institute for the IFRS certification course and registered valuer programs. His articles appear frequently in Hindu Business Line, Deccan Herald, and Bombay Chartered Accountants Journal. So with this very brief introduction, now I hand over the session to our eminent speaker, CA Mohan Lavi, sir. So over to you, sir. I know you were very busy, and I heard that you just completed your one more session, that is certification course program and valuation, and immediately you are joining here. Really, thanks a lot for accepting our invitation, and without an hour gap, you are just continuing your session here also. Thank you very much, sir, and please take over the session, sir.
Thank you very much, Geeta ma'am, for that very kind introduction. And yes, so good evening to all the participants for this session on non-corporate entities presentation of financial statements. This is going to be a pretty simple session because we are just going to discuss what is the format and a couple of issues that could possibly arise in the format given by the ICAI in their technical guide for this non-corporate entities and the presentation of financial statements. Now, the technical guide is already out. It's already been given to, it's in the public domain for the last about 1.5 or 2 months. And this is not something which is actually new. Something has been attempted in the past also. But I think basically what the ICAI has done is that they have brought in some sort of requirement wherein they are trying to standardize this across the country, if I may use that the term across the country here. There's obviously going to be link between the presentation of the financial statements and the accounting standards. So the first thing which I will probably tell you all is that for the purposes of today's presentation, we will not worry about the Ind AS aspect. We will look only into some aspects of Ind AS, not the entire set, because invariably we would probably feel that non-corporate entities would probably be following only the accounting standards. But if any of you have got any specific questions on an Ind AS related, suppose an NCE wants to do a voluntary adoption of Ind AS, we'll be happy to take that up also in the later part of the session. So I think I'll go on till about 6:45 on the presentation itself, and then we can take a few questions before the session is sort of winded up at this thing here. Now, as all of us are aware, we now have a variety of accounting standards in India. We've got Ind AS, we've got AS as per the company's accounting standard rules. And probably what many members would be aware of but have not gone through is the existing AS is also being attempted to be revised by the ICAI. And I've just put it as AS in bracket R. This is not a nomenclature given by the ICAI, so please don't use it anywhere. They are trying to bring out a new set of standards which would be applicable to entities to bring them as close as possible to, Ind AS. One of the significant omissions in the present literature on accounting standards is we do not have a full-fledged accounting standard on financial instruments. AS 30, 31, and 32 was only recommendatory in nature. It remained recommendatory in nature. Ultimately, it was removed, and it is not there any longer as a part of our literature here. And a very important topic, such as accounting standards for financial instruments, you're not having a set of accounting standards that certainly would create some problems in presentation, classification, measurement. The disclosure part we will omit for the present because disclosure is only for the purpose of a need-based disclosure, if I may use the word, right? As far as non-corporate entities are concerned, the accounting standards rules which the ICAI has brought out, they will have to follow it with limited exceptions and exemptions. This is what I've used, both the word called as exceptions as well as exemptions here. So we will only focus on the accounting standards issued by the ICAI right now and focus on what the technical guide sort of gives us as guidance, and also look at the format for the presentation of the financial statements. Now, even before we get into the technical details of all these things, you all can probably come up and ask me a question saying that, oh no, look, this is only a technical guide. Should I really follow it? Because all of us, limited time at our disposal, you know that you have got a tax audit season coming up. It's, not coming, it's already here with you. Rush for deadline, you have a non-corporate entity, you have to finalize it. You have last year's format, you have last year's file, you have last year's details. And now suddenly this thing has come up upon us. Do you really want to do it? Can I do it later? Can I do it next year when I have got time? These questions will definitely crop up to many of you because you all would want to probably look at, ease of implementation, if I may use the word. So there is no mandate as such that you will have to definitely use this from this session, from this season itself. So it's only recommendatory in nature. But I would probably think that the way things are going today and the way, the regulators are looking at the profession and the way things are moving today, it's not going to be very long before this is becoming a mandate for us. It's not going to be probably a couple of years. It's going to become a mandate for us. You may want to have some revisions in the AS for NCEs right now. We may have some changes in the format. But as we are speaking today, this technical guide is only a starting point. You should think of it as a starting point for moving towards presentation of financial statements in a uniform format. So, that is what I'm going to leave you all with for the purposes of, this today's presentation here. So, this I need not tell you all of you are familiar with all these accounting standards here. We are going to focus only on these standards here, going all the way up to AS 29. There are 27 accounting standards which are applicable. And for the non-corporate entities, you've got some disclosure exemptions. You've got some exemptions not there. Say, for example, cash flow statement is not applicable. The cash flow statement itself is not applicable for a non-corporate entity. But you look at foreign exchange rates and, you probably look at other standards like AS 15 on employee benefits. There have been some disclosures which have been given as an exemption for these non-corporate entities. Now, interestingly, what has happened is that the technical guide is a sort of a holistic document which does not look at these specific exemptions as such. What you're seeing in the technical guide is going to be a comprehensive technical guide or a comprehensive sort of document which covers all aspects of the accounting presentation for NCEs without looking at the specific exemptions given by these accounting standards here, especially the disclosure related exemptions given. So I think that is what one very thing which comes out very clearly is that they have not told that in this particular paragraph this exemption is there. That is something we will have to adapt when we do those implementation of these particular NC accounting this thing. So there's always going to be this link between the accounting policies which NC is following and the format of the financial statements. It is left to us to do it. Obviously, they will have to be cross-reference linked and all those things. So that the technical guide is silent on that point, but we will have to do this from our side. Again, a few small changes on this, again for 29 on, the provisions, contingencies, and, the contingent assets, that is applicable with some disclosure exemptions. Now, just to give you all a very broad point on this account AS for NCs, and in particular, you can see that only cash flow statement, for example, is completely exempt. Now, this disclosure exemption is only for the purpose of trying to say that, okay, for a non-corporate entity, maybe so much of detailed disclosure is not required. Therefore, let us give them some exemption for disclosure. For example, for leases, I can tell you all that, maturity schedule for the leases, 1 year, 2 year, 3 years, that is not there. That has been given as an exemption. So there are limited disclosure exemptions. Now, the reason behind these exemptions is obviously been to ensure that the ease of implementing these accounting standards becomes easy for non-corporate entities. But there's another way to look at it. The other way to look at it is that I might as well do the entire disclosure, because anyhow I've done the accounting part, I've done the recognition part, I've done the measurement part. It's only a disclosure part. So why do I want to leave that particular part of it? So again, here the wind blows both the ways. You can choose what is convenient for you all. But typically speaking, if there's an exemption given, why do you want to miss out on that exemption is something you'll have to really think about. But there is a definite requirement that apart from what has specifically been mentioned in these exemption clauses, you all will definitely have to follow all the applicable accounting standards. In fact, I would probably think that one of the omissions which is not there in so the AS1 is that Ind AS has got this clause saying that the company should give explicit and unreserved statement of compliance with Ind AS. We don't find the specific wording in AS, so it's assumed that you're going to follow all those accounting standards without any exception here. So only what has been given as a disclosure exemption, you should probably look at and choose only those exemptions. As I told you all, this AS 30, 31, 32 is going to create a small problem for us. It has already created a problem for us because many of the entities who are having financial instruments, and I've always mentioned this, you just take a very simple trial balance of any of your clients. You take a very simple trial balance and just try to put what is the applicable accounting standard. You will find that AS 31, 32 scores the highest number of hits. For the simple reason that its gamut is so vast. Its gamut is so vast that it covers every possible type of transaction. Say, for example, it covers trade receivables, trade payables, intercorporate deposits, loans and advances, and cash and bank, cash and cash equivalents. Everything is covered under AS 30. Or rather, I'll put it this way, should have been covered by AS 30. Instead, what we have is AS 13 on investments, which is again limited in scope. We don't have too much of details as far as, especially for financial instruments, not much is given there for accounting for investments. So this brings rise to one more small issue we may possibly have. What do we follow for financial instruments? Because this detailed 30, 31, 32 is not there. So what do we follow for financial instruments? Can I fall back only upon AS 13, or should I probably take, say, for example, I go back to maybe Ind AS because it's published, because AS 30 is no longer there today on the statute book, is no longer there today. So what do we do for such type of situations, especially for non-corporate entities wherein you have a particular situation wherein you could have a financial instrument which is not necessarily an investment, but how do you account for it? See, the first response to that is definitely going to be, that you would have to fall back only upon what was published or I'll probably say what is mandatory in terms of what has been issued as accounting standards. So just give me a minute, please. There's some problem in this box here. Okay, just give me a minute. Okay, it's just interfering in the way. All right, yeah. So there's what has been published. So I'll have to fall back upon AS 13. AS 13 says cost and ticket at cost. AS 13 says, okay, certain financial instruments at fair value, I will do that. So I don't have to follow upon other literature. This is what I'm trying to say here. Unless, of course, the standards are revised. So this could be one area where you find a potential weakness wherein, especially in a non-corporate entity, wherein you could have, see, we are not talking only about trade receivables and trade payables here. Trade receivables and trade payables, all of us know. There's an aging now. Aging analysis there, provision is made. This is something which all of us are commonly using for our accounting purposes. But I'm going beyond the trade receivables and trade payables. Now I'm talking about these financial instruments there. So I think there could be a little bit of a challenge there. My suggestion is stick to AS 13. Don't go beyond AS 13 because of the fact that you may get into a situation. Why have you chosen only this for this particular investment here? And if AS 13 is not very what you say, giving clarity on that particular thing, I think you should interpret the AS 13 in such a manner that there is clarity on this. Of course, as I told you all, in fact, I think I should appreciate the many of you have probably not seen this. There is one draft of AS 109 which is floating somewhere out there, given by the ICAI. And I would recommend all of you all, whenever your after tax audit season is over, when you have some time, please go through it, because they have simplified financial instruments in a manner which needs to be appreciated. And whatever is the complications of AS 30, 31, and 32 and 109 in Ind AS, they've sort of summarized it in a very nice manner and split the standard into simple financial instruments and complicated financial instruments. And they themselves have used the word called as complicated financial instruments or detailed financial instruments. It makes a lot of sense to go through that, because that will give you all some idea about how to account for this, even in a situation wherein you want to interpret this as an AS 13 requirement there. We do not have any clarity as we are speaking today about when this is going to come up, but I'm sure that at some point of time, we will definitely have to use it. So this technical guide has been, as I told you, come out a few months back. This is only a technical guide. So a technical guide, if you want to use it, you can use it. You can take it and you can use it to the extent in which you feel it's comfortable. The standard language used in the technical guide is that it would bring consistency and comparability in the presentation and disclosure of financial information reported by the non-corporate entities, and would be of immense use to professionals and other stakeholders. We'll forget the latter part. We'll only worry about the former part. Now, there are different ways, different methods, and different practices being followed for presentation of financial instruments, especially non-corporate entity, because we do not have a Schedule 3, we do not have a Companies Act, we do not have a format, we do not. I'll probably go ahead and say probably don't need a format, right? Because you're used to a certain, say for example, a partnership form, right? For years, we have presented the financial statements in one particular format here. And we've followed all the accounting standards. We've started with the capital account, gone up to the drawings account, and then on the right-hand side, assets, liabilities, the normal stuff has been done. And as I said earlier, a particular method has been followed for so many years for presentation. Now, what the technical guide is trying to tell us is that they want consistency and comparability. Now, these are two terms which may appear to us to be, very simple terms to interpret. And why should we worry about consistency? Why should we worry about comparability? We can obviously compare two financial statements when they are together, or if they are together, we can obviously compare it. But I think we should go beyond just the words and look at this from a perspective of what is going to be the end use of these financial statements. In fact, I can tell you all that the reason why IFRS has become a bit of a popular thing across the world. I mean, for a moment, we can keep India aside because we've gone by the, carve-out approach. We've not simply adopted IFRS. We've done some changes to IFRS, which suits our requirements. Though the changes are minimal, but we still have done it. But there's a very great example given of this consistency and comparability in the presentation of financial information. There's a bank called as Royal Bank of China, and this Bank of China acquired a bank in South Africa, or were about to acquire a bank in South Africa. And this was also a bank which was, in the same business of, I think they spoke about personal lending only. It's not a mortgage lending, basically mortgage lending. But anyway, the Chinese persons had mentioned this statement saying that it was very easy for us to do a valuation. It was very easy for us to get a valuation done. It was very easy for us to arrive at a value for that particular bank in South Africa, because both of them were using IFRS. They said consistency was there, compatibility was there. So we could very easily understand what that bank was doing and what the statements meant, because both were using a common language called as IFRS. The technical guide is attempting to do this for non-corporate entities. I am using the word called attempt only on purpose. They want to bring consistency and compatibility in the presentation of financial information reported by the non-corporate. It's only an attempt. So you all may still want to do it, you all still may not want to do it. But as I said earlier, please be aware that maybe at some point of time, this may become the rule of law also. We are not sure as of today, but at some point of time, definitely, I think this may become the rule of law also. Why is this required? This is why it is required. Now, the ICAI on its part over the last few years, as all of you are aware, has been extremely proactive in bringing out such publications. You've got publications on almost every aspect of, accounting standards, presentation, financial, statement, Schedule 3, in-day Schedule 3, non-in-day Schedule 3. There's a whole bunch of literature out there which is going to give you sort of guidance as to what is to be done for this purpose of presentation. Again, here, they are only saying that it would bring consistency and compatibility. So they only want the presentation and disclosure of financial information to be consistent. And I think the ICAI has taken upon this as a task to ensure that there is consistency in financial reporting across, this thing here. To whom it would apply, I need not mention this to all of you all. Non-corporate entity would probably be sole proprietorship firms, individual family, partnership firms, registered, unregistered, AOPs, body of individuals, even a resident welfare association. The technical guide also goes ahead and says that RWA also would come under this non-corporate entity. So the gamut is pretty, wide. But as most of you are practicing professionals, and as most of you would probably have partnership firms as a set of clients would probably be partners and partnership firms. I think we can look at that only as an example for today's discussion. How have you been presenting the financial statements of partnership firms, and what the technical guide sort of brings out and tells us to do in the terms of presentation of financial for partnership firms. Now, as we go through the presentation, you will obviously know that a lot of it is modeled on the Companies Act. So there is always a fallback upon the Companies Act for pretty much, all the requirements. I won't say all the requirements, but most of the requirements at least. So let me not use the word all the requirements, because there are some things that have been carved out from the Companies Act Schedule 3 also. One important omission here is LLPs. One important omission here is limited liability partnerships, which is not there as a non-corporate entity. So we don't, as we are speaking today, whether I have to use this format for the LLP or I have to use some other format which has been given is again not very clear. But this word called as body corporate, people have interpreted to mean also an LLP. Whether that is right or not is again subject to a lot of debate all across the country. So they use the word called body corporate. They say it also includes a LLP here. In which case, you may want to fall back upon the Companies Act 2013, but Companies Act is not applicable to an LLP here. So my take on this is going to be that since the technical guide is largely modeled on the Companies Act with a few omissions here, I would probably extend my argument and say that I can probably use this format for an LLP also. Because I don't have the rigor of the Companies Act, I don't have the ease of doing my own format. I'm somewhere in between, which is what this technical guide is trying to solve. I don't have the rigor of all the entire companies that schedule by schedule, doing those general instructions, giving those notes and accounts, giving a cross-reference. I don't have the rigor of all those things for an LLP, nor do I have the ease of saying that I do it in any manner I want, any manner I want. So I would use this as a sort of beginning or a sort of a format which I can also use for LLPs. This is my personal view. Many people, they feel that we'll fall back upon companies that only for LLP because it's what called body corporate is there. But I really would not subscribe to that thing, because I think the purpose of this company that is very, very specific. Though for all practical purposes, registration purposes, all that you're using the MCA only. But I would still feel that yes, for presentation of an, I don't have a mandate in LLP. I don't have an LLP act which says that you have to follow this format, this is how you have to present it. So I'm going to go by general format here, with an appropriate disclosure saying that I have taken this format for the purpose of this particular presentation for the financial statements. I don't see a problem there at all. Again, you look at what they are trying to, they've gone further. Statutory corporations, trusts, autonomous bodies in business or profession, and these are fully charitable in nature. So they've given this to a wide gamut of entities. Now, what is out of scope is also very interesting. That's why I told you about LLP will come in here. Unless there are specific regulatory formats, which means that, again, say for example, a bank, formats given by the RBI, insurance company given by IRDA, Companies Act gives formats, as we know. They have given this out of specific format, and they've also given what is not in scope. ICAI is saying is that in case there is specific educational material issued by the ICAI, they've issued one for schools, if I'm not wrong, and they've issued one for educational institutions, if I'm not wrong. If they are saying that if that is there, I think they also have one for political parties. I've seen that also. So they are saying that if the ICAI has issued educational material or technical guides in whatever manner called, for those institutions, use that, don't use this particular technical guide. So the scope exemption is only for specific formats given by either regulators or material which has been used by or issued by the ICAI. Now, again, this brings us to this, eternally, this dialogue, this question always that, okay, I have one educational material issued by the ICAI for political parties, which was issued 4 years back. I have this now. What do I choose? Again, strict interpretation of the technical guide. I'm going to say that they have put a scope exemption here saying that if that is specific, use that only, don't come to this at all. So this is where I think we have to be very clear in what we are going to use here. But I would also think that at some point of time in the future, there is going to be an integration of all these. See, we can't end up having 25 formats for 25 different types of institutions. That's only going to create mayhem all over the place, right? So I don't think we're going to have so many formats. At some point of time, I think a little bit of, consolidation would necessarily have to happen, and we'll have to probably, look at using only a couple of formats, say, for example. So I would still advise all of you all that in case you're following a format consistently for, a partnership firm, it won't take much effort to actually transition to this technical guide. It takes some effort. I'm not saying no effort is required, but it won't take much effort there. And I think you can probably think of doing this as a process. You don't have to do it right tomorrow morning, right? Look at what will be impacted areas. Look at how the format is going to change. More important, look at whether your schedules will change. I think the face of the P&L and balance sheet we can always present. That's not the least of the problems. I think the problem in this implementation is going to be people think the entire set has to be changed. They have some requirements for the general instructions also. Some instructions have been given. We'll go through a specific format today. But I think as long as the face of the P&L account and balance sheet is more or less as per this technical guide, I think 50% of the journey has been crossed. Because your schedules, so to speak, your notes and accounts, so to speak, are pretty much only disaggregation of items of the main P&L account. So you only disaggregate what you're aggregating in the face of the balance sheet. So there I have a little bit of a liberty. I've got a liberty wherein I can put little things up and down and I can see it. As long as it comes into the main balance sheet, I should be happy with that. I mean, you can look at this as manners of trying to implement this particular technical guide. they go on to give general instructions. I told you a lot of these, words used have been picked up generally from the Companies Act itself. They're giving us general instructions, and they have used it very clearly, saying that these formats are recommended for preparation of balance sheet and statement of profit and loss of a non-corporate entity. The moment they use the word called as recommended, all of us are going to lose interest and say, okay, let's log out of the session. Only recommended, not mandatory. We'll see next year. I have got enough of tax audit cases to do this year. Why should I do this particular thing here? So I can completely, I'm in sync with that argument, because unless something is forced upon us, the chances of us doing it are going to be limited. So I'm again not against that principle, nor am I for that principle. I'm a very neutral in that particular thing, right? So I'm going to look at this very dispassionately. I look at this format and say that, is it going to improve the presentation of the financial statements for the entity itself? You forget about the regulator, forget about any of those regulators, forget about banker. I mean, banker, we can't forget, we have to remember the banker, but is it going to improve comparability, presentation? Is it going to add more information, add more value? If the answer to that question is yes, I'll remove the word called recommended from the general instruction. I'll recommend to the client saying that, let's try and follow this format. Okay, maybe in the bargain, you can also charge a little bit of additional fees. It's an opportunity for you to charge. I don't know whether he'll pay it or not, but at least you can attempt charging it, because you can tell him the difficulties involved in converting to this new format here. But I know that is only on a lighter note, so don't think upon this as a fee increase assignment, so to speak. But I think we should look at this in an overall picture of saying that, okay, is this really going to improve? Answer is yes, please do it. I know partnership firms, for example. I can give you an example of Akshaya Patra in Bangalore, who are converted to Ind AS itself. Completely, they converted to Ind AS much before any one of us probably thought of Ind AS. They went to IFRS, in fact, long time back. If I look at Akshaya Patra's balance sheet today and financial statements and look at the technical guide, I'll not be wrong in saying that their presentation is better than what we're seeing in the technical guide today. Because we're just starting on this technical guide. They have been through this for the last 5-6 years on IFRS itself. So all that disclosure, it's like a proper corporate balance sheet being presented by this Akshaya Patra. So you have bits and segments wherein presentation is already happening. So I would think that you look at this from a point of view of, is it going to add value? For example, your bankers, by giving them more information, would they be happy? They normally would. Bankers should normally be happy. But at the same time, look at the cost versus the effort, this thing also. Because I have always believed that, and this is coming in from a lot of regulations, I've always believed that, and I think all of us should also agree on this particular fact, that if the cost is going to exceed the benefit, there's no point in doing it. Let's be clear on that point. Thankfully, for this technical guide, I don't think the cost is going to be much. It's going to be, not much of effort there. So the benefits are obviously going to be what you could possibly be getting in terms of, the benefits or in terms of fees. But just because it's recommended, don't not do it. That's what my suggestion is, that don't not do it only because it's recommendatory in nature. Attempt it if it's going to add value at some point of time. Enterprise level, enterprise user level, at any point of level, it's going to be, adding value. Please definitely use it. They have also gone ahead and said that the disclosure requirements recommended in this format are in addition and not in substitution of the disclosure requirements specified in the accounting standard issued by ICAI. So this again is a very common repeat clause which comes up here. Accounting standards give you certain disclosure requirements, and especially for NCEs, we've got certain exemptions also. The format is asking us to give some disclosure requirements. You will have to give both, provided there is no clash, and there is no clash. That much of care has necessarily been taken to ensure that what is given in the AS has been given in the AS. But you don't have anything which is going to be, again, repeat information given as per these particular disclosure requirements in this particular Schedule 3 here. Dangerous sentence, but still we have to live with it. The technical guide of all places has used this word called as the financial statement should give a true and fair view of the state of affairs of the entity. And the language is very positive language. They're saying that it should give a true and fair view of the state of affairs of the company. Whereas in our company that we are saying that reasonable assurance. So I think this will also have to be a thing which will have to change here, because this word called as true and fair view, the sentence called as true and fair view has been much abused, much interpreted, much misinterpreted, and saying that is the auditor really giving a true and fair view? True and reasonable, probably yes. Reasonable, best, no problem, right? We have to face the fact that this concept of true and fair today is long gone away. We really cannot say true and fair view now, because the fact remains that each and every accounting standard is subject to some sort of interpretation here. Judgments are there, assumptions are there. When we are using all those in our financial statements, how can we give a true and fair? So I think I would definitely want to this sentence to probably change and say that the financial statement should give a reasonable assurance of the state of affairs of the entity. Now, I'm not trying to protect the fact that something could go wrong. I mean, that's not my intention at all. But the word, and especially if they use the word called as should give a true and fair view, it seems to be a little bit of an imposition on the auditor to say that you will have to present the true and fair, especially in a non-corporate entity wherein the accounting standards which we are going to use are going to be only of limited, we will not apply all the 27. But again, in those 27, we may have some standards where there could be a little bit of assumption judgment. Say, for example, AS 29. Very popular example can give you of AS 29. Provisions, and they are talking about the fact that, okay, current obligation from past event, if the amount is certain, it is a provision. Amount is uncertain. If amount is certain, it's a liability. Amount is uncertain, it is a provision. And they are saying that, okay, it will be on the most reliable estimate or best estimate. What is this best estimate? We do not know. I want to create a provision. I know I have an obligation. To the extent of my knowledge, I have made a provision. I've used everything as per AS 29. I've used all the requirements, reliable estimate. I've got probably I've got a quotation. I've got an invoice probably. I've used that to make the provision. But they are saying true and fair. Is that provision true and fair? I'm not very sure, because I'm making it on the basis of an estimate. Estimate can never be true and fair. So I would think that this language has to change, and they should probably say reasonable assurance. Okay. They've also gone ahead to say that, again, recommended where you feel that some of these wordings are not appropriate, they're giving you the freedom to amend, substitute, or delete in the head or subhead or any changes in the financial statements. Complete freedom has been given to them. This gives me all the more reason to adopt this for an LLP, right? Because they are saying, okay, I'm using this as a basis, but at the same time, they are saying that when any of these wordings, because non-corporate entities could have different types of transactions which may not fit into this template given by the technical guide. You could have different type of transactions. The template given by technical guide may not accommodate all those transactions. So what do you do then? Complete freedom has been given there. So they are saying that include addition, amendment, substitution, deletion in the head or in the subhead or any changes inter se in the financial statements or statements forming part thereof. The same shall be made and format shall be modified accordingly. Now again, I'm sure that many of you are going to ask this question. If this is there, I'll go back to my old format only. Why should I keep this format? Definitely a question is going to come here. I think that I want to preempt that question from coming by saying that don't make so many changes that you go back to the old format using in 2021. I think that has not been said here, but I think there's a very clear indication that there should not be done. When they are talking about, substitutions, I think they are talking about transaction level, substitutions or specific substitutions that could come in certain cases only, not the entire set itself. So don't have to go back and reinvent the wheel, right? I think this is one area wherein the technical guide has again, given us a lot of good guidance actually. I won't say that they have done completely as per the Companies Act, but what they have said is that each item on the face of the balance sheet and statement of profit or loss account shall be cross-referenced to any related information in the accounts. Cross-referencing, they are not given an option here. You will have to do it. You adopt the technical guide format, you do balance sheet, you do P&L account, you're doing notes and accounts, please cross-reference them. So here, there is not too much of a, option given to us. If you are doing so, please present, please cross-reference. The concepts of materiality, all that still remain. So you will cross-reference only material items. And again, they have used something which is again very commonly seen in regulatory literature. Balance shall be maintained between providing excessive detail that may not assist the use of the financial statements and not providing important information as a result of too much of aggregation. So don't, aggregate too many things into one particular category. Try to, disaggregate to the extent possible. I can give you all the example of cash and cash equivalents. Margin money held in a bank. Very clearly, the Companies Act Schedule 3 says that if it is not readily, or does not meet the definition of cash and cash equivalents, we put it in other items just below the cash and cash equivalents. Margin money which has been used for the purpose of getting a bank guarantee or deposits for bank guarantee. Those would come under that particular category. So don't aggregate everything only for the purpose of aggregation. That's what they're trying to say. Again, providing excessive detail. I mean, honestly, I don't think any of us are giving too much of a detail, but the the technical guide is saying don't give too much of information or to confuse the user of the financial statements. I mean, again, I'll just give you all one example of too much of information. Again, this company has done it for the purpose of this is not an Indian company. This is a Gulf of Mexico oil spill happened. British Petroleum, BP. In this Gulf of Mexico oil spill happened about many years back. Even today, in their financial statements, they are giving at least 5 to 6 pages of information about what happened, how much they have to provide, how much they provided, how much they have paid. Now, this has been years since this has happened, but still they're presenting it. Now, I understand where BP is coming from. BP is saying that if you want information, it is there. You don't come and tell me you're not provided the information. There have been multiple problems there. Some people who have not, eligible have claimed those refunds and all sorts of things has happened there. At least in the Indian context, I have seen that when it is required to disclose, we will disclose. So the concept of providing excessive information is not going to come to us at all. I mean, not in a negative sense, I'm saying this, but we are not going to, definitely provide too much of excessive detail. That may not assist the use of the financial statements. You will just give one small example saying that this is what has happened. Again, I'll give you an Indian example only. Of course, this is, the examples I'm giving are from a corporate entity only, but you can use it for non-corporate entities also. There was a company which was having, I think somewhere in Nasik or Nagpur somewhere, they were having some land. And they wanted to build some, gated community on that land. So they got into a joint venture with some other person and wanted to get into a gated community. Now that land apparently belonged to the Nasik Municipal Corporation and they wanted a specific permission from Nasik Municipal Corporation. So they went ahead and got it. They went ahead and got the permission. Nasik Municipal Corporation said, okay, fine, go ahead, no problem. But the requirement of this gated community said that, you had to leave some minimum area from the commercial area or minimum distance from the commercial area, whatever it may be. So there were some terms and conditions given. And this company or this joint venture did not follow those terms and conditions. It became a legal dispute. And it went to the court and, they had to put the Bombay High Court case and all those things. Now, this company, in all their fairness, when they started off with this dispute, started by saying that this is what has happened. We paid the Nasik Municipal Corporation. This is what has happened. Case has been put in the court of law and expected to be heard very soon. And this went on and on and on for 2 or 3 years because the case was never being heard. In the meantime, what happened? They approached the government, or they approached the government of Maharashtra and told them, please give some sort of a resolution to this issue, because the fact is that community is not coming up. I'm not able to build. He's also not able to build. Some resolution has to come. The government, because they also had a stake in the land, decided to give an arbitration. They said, okay, we'll call an arbitrator. They have an arbitration award. The reason I'm telling all this is because all this I could read from their financial statements, from the notes and accounts. They gave that much of detail. It is not excessive, but it is basically what is required for the purpose of understanding what is happening to the dispute. You take, for example, infrastructure company. You go to GMR, for example. GMR, almost every oil project is in a dispute. Now, if you are an investor in GMR and you want to know what has happened there, you read their financial statements. You'll get a good idea about what is happening there. They are not given too much of detail. They are not given saying that in this particular part there's a dispute. They don't put a blanket sentence. So they've given just what is required. So we have developed this art of not providing too much of information, but providing only what is required. Exactly what the technical guide wants us to do also. Don't provide too much of excessive detail. Don't confuse the person, or they are actually, the other regulators use the word saying that do not confuse the person. Here they are saying that it will not assist at all. Why are you going to give so much of, what is going to happen to so much of it? Are they going to use it? Is it going to be assisted, useful for them? That's what they're trying to say. Okay, then they talk about financial statements. Okay, this is also done. General instructions. Notes to accounts may contain information. Again, typical repetition of what is there in the Companies Act. They are saying that the notes and accounts can narrative descriptions or disaggregations of items recognized in financial statements, and information about items that do not qualify for recognition in those statements here. Again, here we will have to look at what are we giving the notes and accounts. Basically, notes and accounts consists of two things. One is the disaggregation of the main item, the P&L account. In P&L account, you have one item called as property. In balance sheet, you have one item called as property, plant and equipment. This is one thing. In the notes and accounts, we have a disaggregation. Disaggregation means what? You're going to break this up into land, building, vehicles, furniture and fixtures, all those things. That's disaggregation. That is the quantitative part. You also have to give a narrative description saying that, okay, this land is not in the name of the entity. This land is the promoter's name. This land is under dispute. This land has been sold during the year. Whatever. This land has been encroached. Whatever has happened, building, whatever has happened, those things. So there are two parts to the notes and accounts. One is the quantitative reconciliation and the other is the narrative description. And I think all of us are now pretty familiar enough to say that if I am dealing with property, plant and equipment, or if I'm talking about property, plant and equipment, what I will do is that I will put this as disaggregation and I'll put a narrative description of what has happened during the year. Only important things. I'll not again go back to the previous thing and say I'll not give too much of information also. Anything sold, anything destroyed, insurance claims made for items which have been lost. All these things I'll put in as a small narrative item. Also, information about items that do not qualify for recognition in those financial statements. So in case it's not coming as a part of the main P&L account or balance sheet, but only in the notes of accounts, we'll have to use this. This again is a question which commonly comes up. Rounding off has been used in this particular technical guide for NCs also. Less than 100 crores of rupees to the nearest hundreds, thousands, lakhs or millions or decimals thereof. 100 crores or more to the nearest lakhs, millions of crores or decimals thereof. Once a unit of measurement is used, it should be used uniformly in the financial statements. Actually, I think what they are trying to say here is that when they are talking about rounding off, they're talking about the rounding off the numbers in the financial statements. This, many people have also said that I'll interpret this to mean that I can present only in this particular format, which means that if I am less than 100 crores of rupees, I can present only in the nearest hundreds, thousands, or millions. I cannot present whole numbers. Or if it's more than 100 crores, I can only do lakhs, millions of crores, or decimals thereof. I cannot present in whole numbers again. Or I cannot present, say, for example, in hundreds when I'm 100 crores of rupees or more. But I think since the language uses rounding off, we'll stick only to rounding off only here. In what level of, say, for example, hundreds, thousands, lakhs, whatever it may be, you want to present it. Here, especially for non-corporate entities, this becomes an important point to discuss because, see, if you are going to round off in, let us say, thousands, it's always better to present in thousands only, right? That is going to be a very simple logic which you're going to apply. So if you're going to round off, so which comes to the discussion point that you can do hundreds or thousands rounding off, means you can present any of those formats, any of those options have been given there. The only problem I see here is that if you are less than 100 crores of rupees, crores has been removed. and I don't think, the technical guide or any of the literature should actually tell us how we should do this. But we've got, again, this coming in from the Companies Act. This has also been repeated here in the technical guide here. So I believe, I sort of believe that, they're just trying to give us some sort of uniformity between what is happening there and what has been given here. And they are also saying that I cannot change this. So I have to be a little bit careful. See, in the Indian context, what has happened today is that most of us are used to rupees and lakhs only. Let me be honest to say that. Of course, in a few big balance sheets, we're seeing rupees in crores or so. When we go to SEBI, we're looking at rupees in millions. So we've got, 3 or 4 methods of doing this already in India. Of course, that's only for the corporate world. But I know a lot of enterprises who are partnership firms also who are doing this in rupees and lakhs here. The technical guide is not asking us to change that. They are still, it's lakhs is permitted for, your this thing also. So for presentation purposes, I would think that you all should use only what is comfortable with for you. I mean, what has been done in the past. Would you want to give whole numbers as a set of financial statements, like without using any decimals and complete numbers? That also I've seen in a few formats, whether you want to use whole numbers. Again, I don't have an yes or no answer to this, but I would think that whole numbers is slightly out of fashion now. You may want to probably look at minimum of, say, thousands or lakhs here. Again, convenience is the key here. How have you been presenting and how easy to convert, that becomes the key here for you. So this is what your, the basic format and what they're talking about here. Also, I think, though, one thing which I found missing in the technical guide is the concept of, or a further discussion on the concept of materiality. Because if you are giving me the option of saying 100, rounding off in thousands and crores and all those things, you should also give me a concept of materiality. Again, this goes back to the framework to accounting standards. So I may not want to look at the technical guide for, clarity on what is materiality. I'll go back and look at the framework for AA statements when they're talking about all those things. They're talking about this reliability, what is asset, what is liability, and what is materiality. So I would use that as a basis. I would use that as a basis for all of us to look at concept of materiality. I would always follow up on the framework first. Now here, whatever general instructions I've given, there have been quite a few instructions here. I'm going to use this if it is not specifically mentioned in the framework, which is a very remote possibility, or if it adds further clarity to what has been given in the framework. They may probably give us a little bit more clarity. This is what we will have to look at from the point of view of implementing these particular standards. Now, what the ICAI has also done, sorry, just give me a minute. What they've also done in a very useful situation and a very useful document also to all of us to look at is that they have also given us an Excel format for these financial statements of non-corporate entities. I hope you are able to see the Excel format. You can just quickly reply on chat. Any one person can reply on chat.
We are seeing only presentation. Oh, Excel itself.
Only Excel.
There's a presentation format.
Oh, only one nimsham. Let's see if this works.
Yeah, now Excel sheet is visible. Worksheet.
Now visible. Okay, right. Okay. Yeah, so they've also given us this format, which is going to make your task much more easier, if I may use this word. So you can say here are for ease of preparers, the formats of financial statements presented in the certificate are relevant shall be referred to the basis of preparation. They've only given it for the purpose of, and this is just a very general disclaimer which ICAI is giving. They're giving this in all the standards here. So you can see this format given there. Now, if you look at this format, and since we have time, we can probably go on what you can say item by, as I say, line by line concern. You can go by line basis here. And a lot of this has already been given in the technical guide. So actually what I thought is it's easier for us to look at the Excel format And I will share this with the SIRC also. And actually, there in the institute website, you can probably take it from the institute website itself instead of looking at the SIR. I mean, but anybody who wants it, I can always share it to you all of you and give it to you also, right? And again, as I have said earlier, you look at this from the point of view of two things. Again, when you look at this is okay. This is only a format. We get that. This is only a format. There's no doubt about it. But we are assuming that whatever has been given in the whatever is being presented here in terms of numbers is in compliance with those respective accounting standards. The technical guide is, as we have seen here, is only trying to give you a format for uniformity. And there is no doubt that the non-corporate entity would have to follow the format, number one, read with all those applicable accounting standards. So I think this is something which I wanted to re-emphasize, because just like how we are doing for the Companies Act also, we are using this along with AS or Ind AS as the case may be. So similarly, we're trying to use this also format for the purposes of this particular non-corporate entity. So there are a lot of things which have been given here. You will find, most of you who are today in this particular session will understand that all of you would have had exposure to a certain set of financial statements, no doubt about it. So many things would come out as being familiar to all of you, right? And so what I would probably look at is, I'll just look at a few particular items, try to link it to the accounting standards, and then we can generally follow up on a discussion if this has been followed or not. So you've got balance sheet, you've got P&L account, you've got the notes 1 to 3 on the owner's capital account, you've got this coming up from reserves and surplus, you've got this coming up from the other long-term liabilities, notes to the balance sheet. This is basically, I think, for PP. We've got PP here and notes to balance sheet 12 to 18. Again, we've got a whole bunch of stuff here. A fairly, comprehensive format, and they are talking about a whole lot of things here which has been given. But please remember two things. One is cross-referencing. Definitely required for the purpose of this particular entity here. And we have this thing. So if you look at this from the point of view of a non-corporate entity, we're starting off with equity and liabilities. I do not see why equity should be mentioned here. We can just say funds or capital fund and equity, whatever it may be. But again, as I told you all will, it's easy for us to start looking at what could possibly change in this particular technical guide, because really non-corporate entity, the question of equity does not come in here. Liabilities will definitely come. They can probably call it as capital fund and liabilities, whatever it may be. And they've gone ahead to say that owner's capital account, reserves and surplus, this is something which all of us are aware of. Long-term borrowings, they go to deferred tax liabilities net. They start off with other long-term liabilities. They go to long-term provisions, and then they go to short-term borrowings. And here they've mentioned this. What is hitting us all with a lot of impact now is that in the trade payables also, they have given this breakup of dues to, my MSMEs, which is now becoming the rage all over town, because all of us will have to give this. And other current liabilities and short-term provisions, assets, you're talking about non-current assets, PP, intangible assets. Again, similar to what has been coming up in the Companies Act, under development is coming in separately here. CWP has been coming in separately here. Non-current investments, deferred tax assets, current assets, talks about investments, inventories, trade receivables, cash and bank balances, and all this stuff. We go back to the summary of significant accounting policies, cross-referenced here, and you also have this accompanying notes are an integral part of the financial statements. So this is your basic structure of your balance sheet, or what we popularly call as the face of the balance sheet here. So I definitely don't like the word called as equity coming in here. Owners funds makes a lot of sense, because most of the non-corporate entities have share capital, or in fact, whether you look at it from any non-corporate entity, the word capital and fund are very commonly used. Capital and fund are very commonly used. That should definitely be something which has to be done there. And they've gone by the same current and non-current classification. That has not been changed from what we are aware of in the Companies Act, at least. The trade payables, MSME will have to be done. I don't have to discuss with you all the MSME thing, because all of you are already doing this here. I'm sure that to the extent possible, information is being given. And I'm very careful in using the word to the extent possible, because I do not think that 100% accuracy is possible in this MSME segment here, because basically we are depending upon information which is given by the counterparty, which is I'm supposed to ask, okay, are you MSME? And if he says yes, I take it as an MSME, in which case I have to be a little bit careful on my payout schedule. Otherwise, we'll have some problems there. But I don't think so. Many people have told this for a non-corporate entity, no, MSME will be a real problem. They'll have difficulty. I don't think so. Actually, this is how you capture the data, actually, right? So I don't think there should be a problem, but the MSME Act is gaining a lot of importance. So just ensure that the data capturing is there's a proper system for data capturing of this MSME dues, and if at all it is possible, you can tell the client to probably be careful of those payments, because see, right now it's only a question of disclosure, and we do not know how this is going to change in the future, right? So we need to be a little bit careful about this MSME segment. But of course, the same clause has been repeated here in this particular thing also. Apart from that, in the balance sheet, we don't see much change here. Thankfully, the details of this capital work in progress, aging schedule, all those things have not been specifically mentioned. So I'm assuming that they will not probably be here. But again, you can see that what they have done is the property, plant and equipment, non-current assets, classified into two categories, PP and intangible assets, and intangible assets under development also coming into the picture here. And of course, deferred tax is no need for us to discuss. It's only a net presentation in any case here. So trade receivables are coming in here, and you've got note numbers. You've got note numbers for each and every item at least mentioned here. Obviously, when you are using this format, only when it is applicable, you're going to look at this particular format. And whenever the item has been presented there, you'll cross-reference it or give a note number for that particular thing. I am sure that in the partnership form we spoke about earlier, note number was given, but this was based on what we felt note numbers had to be given. Here, if you look at this particular format, I think it has to flow in sequence, number one. Second, the option of, or the discretion, shall I say, subject to the concept of materiality, we will have to give note numbers for anything which is significant in nature in this particular financial statement. And of course, many things can happen here. Say, for example, the word called balance sheet, for example. There's always an eternal discussion about this balance sheet, And internationally, what many people are saying is that, especially for a company itself, they're saying, please use the word called as statement of financial position. Why do you want to use the word called as balance sheet? What is a balance sheet? We just interpret the words differently. Balance sheet should be a sheet which has to balance it. So, but they are saying use the word called as statement of financial position. Now, I am not mandated by this particular technical guide to use the word called balance sheet. They're saying change when you want, change it if you want. Many of these small non-corporate entities, you may want to use the word called statement of assets and liabilities instead of balance sheet. You may want to use the word called as statement of assets and liabilities instead of balance sheet. In fact, if you go to regional languages, I'm not sure what it is called in Tamil, because I think SIRC conference, many of you will probably be from Tamil Nadu. Finally, from Karnataka, if you look at the regional language of Karnataka and you use the technical word for balance sheet in Karnataka, it uses the word called a statement of assets and liabilities. It does not use the word called balance sheet at all. There is a word for balance sheet also, but I think the general expression, the expression is for statement of assets and liabilities. Now, I am talking about small details here. If you want a comfortable balance sheet, please use balance sheet here. But I am trying to tell you all that in case you all want to change the nomenclature, technical guide gives you all the freedom to do it. So please go ahead and do it, unless and until you feel that you have to use the word called as balance sheet only. One of the recent things which all of you have probably been noticing is this thing called as intangible assets in the development. This is increasingly coming up as a schedule, and even before the capitalization happens, we are supposed to give this intangible assets in development and look at the progress to it to go to capitalization. It could probably go capital, or it could probably be impaired completely in case intangible asset does not come up. You look at a typical startup company, and they have these various intangible assets which have been coming in there. And they are spending some money on development. It may progress to an intangible asset, it may not progress. They use the word called as proof of concept. It may not reach the proof of concept stage at all. what happens in that particular case? It will remain an intangible development and then it will probably go off to an impairment requirement there. But otherwise, sequentially, it should move. It should move from CWIP to intangible under development, and then it should probably go to your capital work in progress. The idea behind this particular presentation format is to ensure that the sequence is captured properly. Again, you look at the next statement, profit or loss account. Let me try to expand this a little bit so that maybe people who are not viewing this may probably see this better. Yeah, let me tell you, I hope this is slightly better. Again, very, very clear, instructions. Again, taken it from the, the Companies Act. They're talking about statement of profit and loss. There itself, I've had many an issue there because, this was a very big argument we had with them. I mean, not we had, but argument when the International Accounting Standards Board came to India and wanted to, implement Ind AS. They said, what is the word called as profit and loss account? How can you have profit and loss in the same year? They said, why don't you call it as income statement? Income can be negative, or call it as profit or loss statement. But if you look at the Ind AS literature and all, you have this varying thing. Sometimes they're saying profit or loss, and sometimes they're saying profit and loss. I'm really getting too much of nitpicking here today. So I would probably say that I will change it to say profit or loss. I'm not going to say profit and loss. But many people have defended this also and saying that, we can have profit and loss in the same year. Because, Air India, for example, 31st March 20 balance sheet, Air India is saying profit, CLG is saying loss because of something. So, I'm not going to get into those details here. But again, freedom is given to you. Why don't you use it? Use the freedom to change what you want to. No surprises on the top half of the P&L account. Revenue from operations, other income, COGS, employee benefit expenses, finance cost, depreciation. Very clear. No problem at all for us to present because we are very clear here. And then, unlike Ind AS, AS has got both exceptional as well as extraordinary item. A very interesting thing has been done in this technical guide. They said that if it is exceptional item, specify what is the nature and provide a note. If it is not there, delete it. This is very interesting because what they are saying is that if you've got an exceptional item, you specify it. You give a note saying that, okay, this is what it is. If it is not there, simply remove from the face of the P&L account, not required. Similarly for extraordinary item, right? I think the difference all of you all are pretty much aware of. The exceptional item is an item which is not in the regular course of business, one-time item, which will have to be presented separately. Or extraordinary item is something which is in the, what you can possibly call as normal course of business, but the amount is so huge that you want to show it as a separate item. The standard, the technical guide is very, very clear, saying that if it is not applicable, please remove it. If it is applicable, you please take it into account. Revenue from operations here. Take it into account, look at your accounting policy for revenue recognition, and from the accounting policy, total amount of revenue coming in here, you try and link it with your total sub-schedule and cross-reference it to your main schedule here from the revenue from operations here. Then, of course, we go back to the other popular items. We talk about tax expense. We talk about previous year's tax, deferred tax, total net amount here, and profit or loss from discontinued operations and tax expense of discontinued operations. Again, there's only one simple item, one simple line item for discontinued items here. You just have to use that item here, and then you get profit for loss are the net figure here. And they also go on to say the accompanying notes are integral part of the financial statements, which is the standard clause we use in many, many places. So really not much of a surprise in the P&L account, apart from the fact that, you have two main heads for the revenue side and about 5 heads for the expense side. And we have got this concept of extraordinary exceptional items, which also will have to be presented separately here. And then, of course, the tax part comes in, deferred tax also comes in separately here. So really not much of a issue as far as the P&L account is concerned. But again, very interestingly, what they are speaking about for a non-corporate entity also, they have specified this requirement of having to do discontinuing operations on a net basis. So discontinuing operations on a net basis you have to do. Now, this is a pretty interesting situation here because if you look at, again, Ind AS, you've probably got Ind AS 105, which will come in and say that, okay, you've got assets held for sale. So there can be a discontinued operation there also. The very specific standard is here, is there in Ind AS. In AS, you don't, assets held for sale is a part of your PPE itself, right? unless you have got, the entire unit which is being sold, which is being held for sale. So the requirement of the technical guide saying that you should do this from discontinued operations, in the absence of a specific accounting standard on this, becomes a little bit more challenging for us. Yes, you may have one division which is being sold, definitely. You may have identified it, sold it also. But under the accounting, it's being merged under one particular accounting standard, but here you have to call it out separately and show it as discontinued operations. Surprisingly, what I did not find, what I found surprising in this format is that for discontinued operations, there is no reference, no cross-reference required. So I am assuming that in your narrative portion of the notes and accounts, in the narrative portion of your notes and accounts, you will have one particular paragraph which is dedicated only to this discontinued operation here. Maybe it makes a lot of sense for all of you to probably put that note number here as a cross-reference, so that the idea behind this entire presentation is to ensure that people link this with each other. That's the only thing which is important for us. Now they have said that background of the entity and significant accounting policies. They just put note number 1, note number 2, and note number 3. What is our normal equity share capital note has become something called as owner's capital account. Owner's capital account, name of the owner, share of profit or loss, opening balance, what happened during the year, withdrawal in the year, share of profit, and closing balance here. So typical partnership firm accounting, I won't say policy, but accounting principles they have tried to use, right? Because they're talking about opening balance and what has happened during the year. Very interesting. They use the word called as name of the name of the partner is obviously there, but they have used this thing, share of profit or loss, as a what is the opening balance and what happened during the year. This is just like how you do a reconciliation for any item which is there in the balance sheet, and do a disaggregation or something on the notes and accounts here. What capital introduced during the year? What is the remuneration during the year? I'll take you all back to the partnership firm we spoke about. In the partnership firm we spoke about, we may not have so many columns. It will just be total opening balance, additions, withdrawals, closing balance. You will find that this technical guide is asking us to give a little bit more information here. And maybe you all want to be a bit careful, because this remuneration to the partner, income tax, requiring now all this faceless, nameless, blameless assessment is happening. You all may want to be a little bit discreet here. I'm not saying you all should not do this format, because anyhow, the income tax officer, if he wants to find out, he'll definitely find out. But again, the general trend seems to be giving a little bit more detail, or more level of detail, shall I say, than what was previously being presented here. So they've used the word called as owner's capital account. Now, if you just step back for a moment and look at significant accounting policies, here, I still very clear that you probably had some set of accounting policies previously. You follow the same accounting policies. The change in accounting policy as per AS, as per accounting standard rules, because that's what we're trying to follow largely here. Ind AS will come only when there's a specific requirement from Ind AS, or when you transition to Ind AS, or there's a new standard which is being introduced in Ind AS. But really speaking, for a partnership firm, you may not be able to change your accounting policies unless driven by circumstances. You may have, say, for example, a depreciation. You may want to probably look at it from a different concept. But now again, if you look at it, it's only change in estimate now, not a change in accounting policy. The chances of your having, what I'm trying to get at here is that the chances of your trying to put a separate accounting policy only because of the technical guide is going to be very limited. But I will also give one piece of suggestion to all of you all. And this is coming from a very broad perspective, not from a very specific technical guide perspective, because the technical guide is silent on the accounting policies. They're not saying what is to be done. And I'll go back to the end purpose of this technical guide, why we want this technical guide. Okay, they're saying uniformity, reliability, consistency, all these words are being used. Now, the end purpose appears to be to give information to the user of the financial statements, whoever it may be, so they understand these statements better. That's the entire purpose of this technical guide, actually. It could be a banker, investor, private equity investor, angel investor, whoever it may be. He has to understand these accounting standards, the accounting statements better. Though the technical guide is silent on accounting policies, says please follow what you've been following previously. Go back to the AS only. Many a time we have seen situations wherein accounting policies are simply mentioned as one-line statements. I go back to the most popular thing I've seen in many non-corporate entities. They say that revenue recognition. They say that revenue is recognized and transfer a significant risk and rewards. Over. Accounting policy is done. AS 15, you've got a lot of accounting policies. You've got 4 or 5 paragraphs. But revenue, important point, simple, one-liner saying that transfer a significant risk and rewards. If you really want to be in tune with the better presentation, understanding reliability and all those things, my suggestion would be that, okay, don't write 5 sentences, add 1 more sentence. What is that significant risk and reward? What is that event? Is it transfer? Is it delivery? Is it, shipment? Or is it contractual, obligation? Whatever it may be. Just write 1 small sentence here. I'm saying this with a purpose. The purpose I'm saying this is that we're all moving towards a situation, we're all moving towards an age wherein we are talking about giving more information, so questions are becoming less. And as many of you who are probably doing GST practice will remember that for GST, at least for the point of view of revenue recognition, the more information we give, I do not know whether I should say the better it is or the worse it is. But I think as we are speaking today, it's not very good to give too much of information to the GST because they don't know what to do with existing information. But I don't think we should look at it specifically from the point of view of GST and all those things. My only contention is that when you're moving over to a new technical guide, giving more information, relevance, reliability and all, give a little bit more detail in the accounting policy also. Let the user know that you recognize revenue only on delivery. Or all your contracts are CIF contracts. So you give it and hand it over to the agency. You use some language to ensure that a little bit more of detail is given there. Then what happens, reading the financial statements, people will know that, okay, this is what the significant event is. The GST department will also know that, okay, only then revenues have been recognized, only then invoice will come. He may not ask you too many questions on that particular area, provided, of course, he understands what is CIF contract also. But the idea seems to be moving towards just giving that 1 more level of detail. That's what is very important. And I'll go back to my point here. They say owner's capital account. So 1 small omission, what we should probably omit is that on the face of the balance sheet, we saw the word called equity. It has no place in this technical guide. It has to be removed because here they're not talking about equity, they're talking only about owner's capital account here. So I think that will definitely have to go. Reserves and surplus, again, subschedule, not talking, speaking only about, the loans, capital reserve, revaluation reserve, and all these things. Borrowings secured from banks, other parties, loans repayable on demand from banks, other parties. Very interestingly, the format says about loans repayable on demand from the banks and other parties. Deferred payment liabilities has come in here. Again, we'll have to look at what deferred payment liabilities are. And they've given again a very specific clause or sentence saying that loans and advances from related parties. Related party disclosures will have to be done. We have no escape from related party disclosures. We have to do it here. Specific line item there. The long-term current maturities from finance lease obligation has been given here. But if I look at the AS, I have a disclosure exemption there. So there's a bit of a clash here, whether I have to present it here and give a disclosure exemption or I need not present it here also. I am going to say that since I'm going to follow the accounting standards, I'm going to follow that and take that avail that exemption. I want to avail that exemption. So I may not want to present here because I've got a disclosure exemption. And this is nothing but a disclosure on the face of the balance sheet. So this is not on the face of the balance sheet, only a subschedule. So therefore, I will not disclose it if I've got a specific exemption given as per the relaxation given by the accounting standards. Again, secured loans, unsecured loans, 2 separate classifications. Again, we talk about deferred payment liabilities here. Talking about from related parties. Again, this advances has come in here. You look at the footnotes carefully. Nature of security to be specified separately. Terms of repayment of loans, others loans may be stated. I'm going to put maybe in capital letters for all of you. And, all these things are mentioned here. So, where loans are guaranteed by the partners or proprietors, such amount may also be disclosed. Again, this is all something which we are not used to. We've never been saying this in the past. Please remember this. We've never been saying this in the past, saying that this loan is guaranteed by the director or partner. We're supposed to mention this now. But again, with all due respect, they're talking about may be disclosed. They're not saying should be disclosed. Deferred tax, again, all of you all know what are the deferred tax. See, because of the technical guide, I don't think the components of deferred tax will change. Presentation will not change. Rate of tax will not change. Reversal will not change. It's only a disclosure requirement. So whatever you're doing separately for deferred tax, or in case you all have not done a separate schedule for deferred tax, you all may want to take this up and put it as a separate schedule here. Again, all this is only recommendatory. So you don't have to mandatorily do on schedule here. But again, this is just something, you just look at the format also given. They're talking about what is the charge for the year and what is the closing balance end of the year. That's also an important change made. Other long-term liabilities, they speak about advances from customers. Others, we have to specify what they are. And the provisions for employee benefits and gratuity, again, go back to AS 15 there. Actual valuation report is required. And in that particular case here, total provisions have been mentioned here. Trade payables, already on the face of the balance sheet, we have got we've got a disclosure for MSMEs that will also have to comment here. And this disclosure related to suppliers, let me again try to put this in the format. This disclosure related to MSMEs, which talks about amount remaining unpaid, the interest portion, all this which we are so familiar with. This also has been given as a suggestion for non-corporate entities. One area wherein I'm quite sure that all of you will be a little bit hesitant probably to do this because of the fact that, the hesitancy comes from the fact that this information may not be available. How do we capture this information? But I think we also know from, at least dealing with the client and all those things. Yes, he has identified MSMEs, no doubt about it, right? And there have been different practices given for this particular clause. Some people say that section 16 says, okay, thrice the RBI bank rate, I'm going to do this, I'll provide for the interest, I'll disclose the interest. Some people say just give a disclosure saying that we've identified to the extent possible and provided for the interest and all those things. Different practices are going on all over the place in this. But your principal and interest are going to be what is there as per the standard only, as per the requirement only there, right? This is something which we may not have done in the past because MSME disclosure may not have given specifically in the past because it was not specifically covered here. Now we have to look at this. So again, this is an effort. This is an effort. This calls for data, calls for information. You all may want to think of this on a slightly more long-term basis. The MSME Act is not going to be amended anytime soon, so this will become a requirement in the future also. Look at it on how you can probably implement this, in what manner you can implement this. Is it going to be immediate? Is it going to be at some point of time in the future? So this is what is going to be important for us to look at, right? Current maturity of long finance obligations, I already told you about that. If you are using that exemption on the AS, please don't use it here. Don't give it here. Again, these other current liabilities, all these clauses and all these things are optional. Only if it's applicable, you have to do it. Otherwise, not have to do it. And as the format also suggests, you can change the wording, you can change the names, you can change the requirements as per the requirements here. I think another area which is a slightly delicate area, which I thought I should probably highlight to all of you all, is that this related party transactions, loans given by the directors, remuneration paid. I am not sure whether I'll be 100% correct in what I'm saying here, but since it's a partnership firm and we are being found, we've been following AS for a large part of our time. We have not been so elaborate in our disclosures. For example, amount guaranteed, even remuneration for that matter, we give just one block figure. We don't talk about the various other aspects of it. We don't give a breakup as given as required in this format. Now, there is obviously going to be some degree of pushback from the client saying that, why do you want to give this information? And I think this is only a sort of it's justified if you look at it from his point of view also, because the general feeling has always been that if I give too much of information, people do not know how to absorb that information and more questions may be asked. I think this is a very general topic I'm telling, not specific to either MSME or only to related party transactions or loans. It's a very general thing I'm trying to tell you. The hesitancy comes from the fact that yes, I had a 3-page balance sheet, I had a 4-page balance sheet, I had a 5-page set of financial statements. Now you are making it 8 pages. If I look at this, it may probably come to 10 pages also. So there could be a certain pushback from the client saying that why do you really want to do it? What is the going to be benefited here? And all that questions are going to definitely crop up. So this effort of presenting the as per the technical guide for non-corporate entities is a 2-pronged effort. If he does not agree for this, there's no point in even going one step ahead. You can sell it to him as a concept, but yet whether he's going to give it, because I know that many of the people are cagey to give this information. In fact, if you ask me also, I'm not want to give too much of information also, right? And okay, what do you want to know? You want to know, okay, what is MSME dues? I'll give it to you. Fine, no problem. You want to know this particular, how much has been provided for interest? Yes, I'll provide for interest. Whether providing or disclosing, I'm not going to, that's going to be a question of a challenge all the time, right? But what I'm trying to drive at is how far can the client go in changing his existing practices to move towards this technical guide? This is the question which we all have to answer here, because end of the day, if he's not comfortable, and I told you earlier also, this is an effort. Effort requires time. It requires resources. Resources will have to be rewarded. This is not a pro bono exercise you're going to do. It will definitely have to be on a chargeable basis. Some sort of arrangement will have to be looked at. And if you go and tell the client saying that, this is more reliable, relevant, and comparable, he's not going to buy it. He's not going to buy those concepts of more relevant, reliable, and all those things. I think the way we should probably approach this to tell him is that the entire presentation of financial statements or the entire concept of presentation has changed nowadays. It's going towards a little bit more, giving more details here. And this is a format which has been given by the ICAI. We are talking about this from the point of view of probably becoming mandatory in a few years' time. The best time to start is now. And again, I don't want to get too much into TDS and GST. Nowadays, there's so much of information available across various situations. AIS is giving some information, your TDS is giving some information, 26A is giving some information. So there is a lot of information. In fact, the GST department itself is becoming the source of information for many of these other departments. The GST department, maybe participants may not be aware, but they have a ton of information about you. I mean, each and every month when you file your GST R1 and 3B, they're gathering more and more information. And you must have probably read the statements and they're going to machine learning and all these things to try to extract this information. The only problem I see from that is that they have information, they don't know what to do with the information. They don't know how to ask the question. So I would still see that giving too much of information is not required. But if you just follow this format, which has been given, and write a little bit more on detail in accounting policy, adding that one more sentence, adding that one more line, I think we would have made substantial progress in moving towards this common requirement here. As far as the PPE is concerned, we are speaking only about owned assets here. We've got tangible assets, we've got all these things here, nothing new in this format. And again, as an audit procedure, maybe you want to tie this up with the FAR. Please look at the FAR, because in the non-corporate entity, maybe the FAR is not a document which you want to insist on. And again, here you look at the intangible assets, goodwills, brand, monuments applicable, you have to use it. Trademark, all these things have been used. And we spoke about capital work in progress. Again, intangible assets under development, only a simple disclosure of what is under opening balance, addition to the year and the closing balances. Investments in trade investments quoted, this AS 13 says, you have to do it at fair value, quoted price. Other investments in preference shares, investments and unquoted investments, this will probably come in at the cost. And you got this value of aggregate market value at the end of the year, quoted investments, unquoted investments, provision for diminishing the value of investments. Again, all this is flowing in from the AS 13 itself. One thing which has been given by the technical guide is details of investment in a partnership firm. They've given this separately, saying footnote 1, name of the partner whose share of profit in the firm, giving further details, total capital of the firm. Now, I am not very sure why this has come in, because if a partnership firm is, sorry, if investing in another partnership firm, they're asking us to give more details here. Individual partners, cross-holding of partnerships, basically. I think that's what they're trying to talk about here. But I mean, obviously, it will be given only when it is applicable. If it's not applicable, I think you don't have to give it here. But you look at this investment schedule, we are talking about normal investments which could probably come in from, many of the known situations wherein, debts, preference shares, such things will be investment in other entities, like partnership firms, corporate entities. Sometimes also we talk about, the intercorporate deposits, intercompany deposits we speak about, but here they could give a deposit with some other names, and all those things would probably come in here. So not much of a requirement here. Again, a typical NCE may not have all these clauses, may not have all these things. So you choose and you can present only what is required. Capital advances considered good, considered doubtful, advance tax and TDS, Senate credit receivable, VAT credit receivable, services credit receivable, GST input receivable, all these things have come in here. Security deposits, balance with government authorities, all this, again, something which all of you are aware of, so I'm not going to get too much of a detail on that particular thing here. Now here, again, we know that other loans and advances are driven by, what is not considered as a loan will probably be considered as an advance. We know that concept very, very well. And capital advances and all those things have been given here. And every single schedule here, every single subschedule here, they're given this thing called as what is the provision for doubtful advances. And they have given this thing called as loans and advances to partners or relative of partners. Which brings me to a very essential question. And you also saw this even in the other schedule on loans and advances to related parties. The definition of related parties is coming from the AS, obviously, right? Not from the Ind AS or not from the Companies Act, not from SEBI also. So strictly follow what is given in the AS for related parties. Only in those cases you have to give this particular information, this particular disclosure. Again, when it is applicable, you have to give it. When it is not applicable, probably remove that line item here. So this is all, simple things, all very clear things. Inventories, raw materials, work in progress, finished goods, stock and trade, stores and spares, loose tools. Again, all things familiar to all of you, loose tools, others. Goods in transit to be disclosed in the relevant subhead of inventory. So in your subhead, you have to give, suppose you have got raw materials, you've got work in progress, which is, work in progress, you've got some GIT, put that separately there. Again, here, as a very general comment, I felt that the slow and non-moving stock, it's a very popular item, especially now post-COVID. I think non-moving stock is a very important item there. I would have thought that, there should have been a separate item for that in this technical guide, but then again, they can't think of all the possible situations. So I think they may omitted only because of that particular reason. But I would strongly advise all of you all, in case you have got clients who've got inventories not sold for some time and, which are different in values, I would suggest that you put in a small line item here for slow and non-moving stock, because the valuation will obviously change. The valuation will change depending upon this particular thing here. So I think you should probably look at this from that point of view, right? Trade receivables, no ECL model, no problem at all. No need to provide on the basis of ECL model, just provide on a need-based situation. The payable when ables will probably come into play here. Only then you have to look at it from the point of view of this thing. Checks, drafts, and nothing, other bank balances. Again, nothing surprising here. So interest accrued but not given deposits. Again, all this is known to you. Notes on the P&L account. Very interestingly, they speak about the sale of products, sale of services, grants or donations received. I think somewhere whoever has done this format has suddenly remembered that, okay, NCEs may have donations instead of grants. Many of the charitable institutions may have donations received. So they put in a separate line item for grants and donations received. Again, go back to the AS for how to treat the particular grant. And other operating revenue from operations, remove the excise duty. I would assume that GST also is going to be on a gross net basis only. So remove the GST part also. Other income has been shown separately here, and cost of goods sold, COGS has come in separately again here. So the P&L account schedule looks pretty clean. Nothing much for us to discuss in the P&L schedule, because we have got this very clearly coming in from what we already know. And I think most of this we are already giving it. So your normal P&L schedule even today would probably have these components here. Employee benefits, yes. Finance cost, again, broken separately. New item which they thought of is on assets on finance lease. What is the finance cost in that? Because you recognize an interest expenditure there, so that will come in here. Loss on forex is also being coming in as a finance cost here. Depreciation and amortization, other expenses. This is a schedule which all of us are very familiar with, and this is also going to be creating a little bit of trouble for you for your clause 44 in the tax audit report. But that's a separate discussion altogether. Auditor's remuneration, stationery, all this. So I think if you look at this format in general, and we are talking only about 25 notes. They've thought of 25 notes. I don't think in most of the entities which all are implementing this, and even 25 would come in. I don't think you'll have 25 notes also. Maybe I'm thinking maybe 19, 20 maximum will be there. But again, the reason why I thought I'd discuss this Excel is because what has been mentioned here has been repeated in the technical guide in narrative form. I only wanted to give you all the format and discuss the format here. We know the broad parameters. Current, non-current, mandatory. Exceptional, extraordinary items will have to be shown. Here, in this particular format, they are against related party transactions. You have to show what are the transactions separately, or give a small footnote. What are the transactions related parties? The main change I see in this is probably on this note on this partners capital, wherein owner's capital account, wherein we are giving a little bit more information than is what was previously being given there. So you could have a challenge there in terms of trying to give this, because again, you're giving the remuneration, you're giving the interest separately, you're giving all this separately. So again, think about what your friendly income tax officer will probably look at this, and how will he probably refer to this in this particular thing. Otherwise, I really think there is not much of a challenge in this particular format. I'm quite sure that all of you who want to adopt it would probably adopt it. I will before I take up the questions, what I will do, I think there are some 8 or 9 questions which I try to address. I'll give a general comment on something which I feel is very important, not only from the point of view of NCs, but generally you can apply this even for your corporate entities. One significant omission I found in this schedule, or not much of importance has been given to this concept of impairment. And I think that this is a concept which we have to discuss on thoroughly, because especially post-COVID, you're seeing a lot of impairments happening here. Now, the technical guide has obviously said, okay, you have an accounting standard, please follow the accounting standard for this, obviously. But I did not find any specific format here for impairment or a clause here for impairment. And as we are probably aware, there is a lot of impairment going all over the place now. So we will have to look at what we do separately here. But again, I'm going to fall back upon the general, clause which says that you can add line items, you can add on line items if you feel it is necessary. So my point is that if there is an impairment which has been done, you please put it as a separate line item there. And accounting policy, you'll obviously have an accounting policy for impairment. Please ensure that it is done here. But the more basic problem in impairment is that, I think this is something which is many of you are probably experienced also, right? And probably, I've wondered what is to be done for this. Now, we all know this as a statement of fact and a statement of reality that it is the management, the responsibility of the management to look at impairment. As an auditor, you may not, probably, what should I say, discover an impairment, shall I say. You could have indicators. Sales have gone down, good impairment thing. And all of you are probably aware. Now, this entire discussion from last evening has been about these results which have been given by Byju's. I don't think anybody has even waited so much for the results than they waited for this company called as Byju's results. And if you look at the results of Byju's, we're getting very mixed signals there. Some people are saying it's very, very good. Some people are saying very, very bad. We do not know what to be done with those results. But again, I think what is missing this entire discussion is that those assets which Byju's is giving, what is the impairment on those assets, those tabs they're giving? Because the charge has been that once you sell it to a parent, they're not going to use it again, because they're not using the tab again, or that, whatever that app again, whatever they're trying to give you. There's a lot of impairment is happening there. Even you take the Companies Act, I've always mentioned this as a general comment. You take Caro, for example. All of us know this. There's nothing wrong in this. We use checklist for Caro. And our checklist is based on what, Caro format is, those clauses in Caro. 1, 2, 3, 4, 5, all those clauses, we use checklists. And the checklist will normally say, okay, did you have an FAR? Answer is going to be yes, I had an FAR. Did you do a physical verification of the FAR? Yes. The third question should be, did you have an impairment test? That is not being asked. Because it is not there in the Caro, the question is never in the checklist. Because the question is never in the checklist, it's not going to be asked also. Because it is not asked, there's a very good possibility that it will be missed. So I would probably think that, and I'm talking about this specifically from the point of view of, this post-COVID situation wherein we've had a lot of impairment of assets. The hospitality industry, for example, has been the worst impacted. Many industries have been impacted. So I would suggest that though there's no specific, what you can possibly say, clause in the technical guide or no line item in the technical guide, you have an AS on impairment. Use that AS. If it is required, test for impairment and disclose it separately. I would always suggest that this impairment becomes a very important discussion point. That's why I'm trying to re-emphasize this. See, the impairment, the amount of loss is only Excel sheet calculation. That's all. Amount on loss and impairment is very simple. It's only Excel sheet calculation. Nothing to worry about that. We know what is the value in use and all those things. We'll do it. Recoverable value we'll do, and we'll get the fair value. Somehow we'll do, and that's Excel sheet only, not a problem. Most important part of impairment standard is timing of impairment recognition. When do you time it? What is important is recognition of the timing. So impairment should be recognized when the indicators of impairment are very, very clear. You can't postpone that. That is why I'm saying that we'll have to think of this not only from the point of view of Caro. You can also add this as a general clause. Add this as a general clause in your checklist and tell them that, see, there are indicators going to be available. Number of units of production coming down, total revenue coming down. I'm not saying it is because of impairment. It's a possibility that the machine is not working at full capacity. But it is not our job to investigate. So I would still go ahead and say that please ask this question on impairment, because it is very important to ask this particular question of impairment. So this is what I have, asked for this particular thing here. Okay, now I'll probably be ready to take up a few questions. And let me first go to the chat box and see what is there. Okay. Shubham is saying, I am from Akshaya Patra. Okay, thank you, Shubham. Very good presentation. I hope you agree with what I'm saying. Okay, Prasanna is asking, unwanted line items can be deleted. Yeah, obviously. You don't have to follow this copy paste. You don't have to do this. Whatever is not applicable, please remember that you can easily delete it. Don't have to use it at all, right? So that has been answered. 22 is applicable to non-corporate entities, and is it mandatory to follow it in respect to the material amount? It is mandatory. It is applicable, obviously. It is. I mean, you have to follow it. Materiality, okay. See, Satish, what I will say is that you follow the accounting standard first. Unless a specific exemption has been given, you follow the accounting standard. AS3, for example, exemption has been, don't follow it, no problem. 22, you follow it. Then look at the impact and look at the materiality threshold as for the entire entity, I'm saying. Like, look at it from the point of view of revenue, sales, and all those things. Look at it. So you, first of all, you follow AS22 and then not present it based on the concept of materiality. Kishore is asked, for the presentation of financial statements be present in lakhs or in crores. For income tax filing, we should have to put the financial. Okay. Kishore, this is a very, very good point, and this has been coming across all over the place. I do understand that, this is a real challenge, because unfortunately, Winman and all those softwares do not take lakhs or crores. So I'm looking at this from two aspects. One is that, we're definitely not going to change your income tax. There it has to be presented in whole amounts. But here, I can tell you this, that pain will have to bear, because that conversion pain we definitely have to bear. I've asked a couple of my friends also who have got partnership firms, who don't have too much of, the balance sheet is not very high in value. No, I've asked them whether they're comfortable doing it in rupees. They said, no, we want to do it in lakhs, because it's optional. We're okay with lakhs. Income tax, we'll have to tackle it. We'll definitely tackle it. No problem. Sorry. Okay. Again, Satish has come back and said, if an NCA has provided a provision for gratuity, bonus, expenditure, should we follow the AS and employee benefit? What working paper should we take for it? I provided for a provision, bonus as an expenditure. Should we follow the AS on employee benefit expenses? See, you don't have an option. You will have to follow the AS. AS is mandatory now, so you will have to follow it. I mean, AS for employee benefit is mandatory. Only thing which you got an exemption for is the disclosure requirement. So you may have to, take the documentation. If actual evaluation is required, please take the actual evaluation report, keep it as a copy there for you, and that is what you should follow here. If it is actual evaluation is not required because of number of employees and all those things, the company is making a provision, check the basis of provision. That becomes an important point for you to discuss. Kishore has come back and said, can we use statement of profit or loss instead of income and expenditure statement? Absolutely. How to present different type of corporate and non-corporate reserves and surplus? Can we change the schedule format of reserves and surplus? Again, Kishore, again, a very good point. You go back to this note here. Look at your reserves and surplus here. So basically what Kishore is asking is that, can I change this in any manner I want? Because you could have specific corpus funds. You could have corpus funds which are specific in nature. You could have general corpus funds. Can I change it? Answer is yes. But we should also remember that to what level of disaggregation will you all go to? You've got 18 funds. You can't present all the 18 here, right? Again, you'll have to pick and choose what are the most important funds and then only do that on the basis of that particular thing, right? So that's what I would probably say, right? Guidance note on tax audit is it referring technical guide, and so it's not mandatory to follow guidance note. So in other words, technical guide is not mandatory, Satish. It's only a requirement. It's only a suggestion, that's all. How unearned revenue and income received in advance are different from each other. Okay. Kedarishwaran has asked this question. How unearned revenue and income received in advance is different from each other. So I'll put this in a context of, unearned revenue is basically, if you, a typical advance given, right? Typical advance given. Let us say you give me an advance. I have to do some work for you, right? You just give me an advance there. And you said, okay, do the work in some point of time later on. So I do the work later on, I invoice you, I get the money here. So this is unearned revenue, because until I do that job, I'm not, done this thing. What you can say, I'm not eligible to claim that as a revenue here. Income received in advance normally goes on a project basis. Let us say that I have given you an option, or I've given you entered into agreement to do, so let us say deliver 5 products. All the 5 products revenue I've got in advance. I delivered only 3. Those 3 will be revenue. The remaining 2 will be income received in advance. So that's a difference between your unearned revenue and your income received in advance. We are having only WDB for all the assets as income tax act. How can you take gross block for the assets purchased back when the details are not available? Again, go by what you know. If you have got information, please do it. Otherwise, it's not required. Abhijit, can we delete the line items? Already answered. Oh, Vijay is there. Vijay said his internet is weak. Okay, thanks, Vijay. Preparation of cash flow requirement is required. No. Cash flow omitted for NCs. Don't even try that cash flow statement. Don't even try it. SIRC is saying that MCQ, okay. Rent is shown on the other expenses in both 25C as well as 25G. Let me go back to 25 now. 25C rent, 25D rent rates and taxes, including, that's a good point. So with a good catch, I also did not see it. Rent rates and taxes excluding taxes on income. I did not, just delete it. Don't present it separately. I mean, I should go by 25C only, not 25G, because normally we are used to nomenclature rates and taxes. So I do not know why rent has come in there. But as I told you all earlier also, a lot of amendments, a lot of changes will have to be done for this. Quite a few will have to be done. Okay. Again, many of these things are, I think, common repetitions. So I'll just sort of, quickly look at what is there in the format. Okay, Vijay has said, is it mandatory to use the format? I've already answered this. What about LLP? Who's Prasanna is asking? LLP, I think LLP I answered Prasanna in the session itself, so that's okay. I think that also has been done. Anonymous, unwanted heads, yeah, unwanted heads also we can put, no problem. Nagarajan sir has asked this question, will not rounding off NC's post problem income tax here, the insist on here is again you have to reproduce statements again. again, Narendra sir, I completely again get this point, because our villain today is going to be the income tax department, because they are going to be the people who are going to sort of, ask for whole amounts and may not understand, because they have got used to a certain way of looking at these assessments. So they may not want to do this, but I would still think that, I'll go back to my original point, which I made, and say, yes, I will look at this separately. I'll put it this separately. I'll put that separately. I don't want to, do this thing yet. Mohan has asked, where's the question of equity? Good point. I raise this point again for this thing. Again, Kishore has again asked this question on income tax. So we've done that. We've already answered that particular question. So technical guide also done. Shall we fill up the columns in income tax return for rounded off figures? Again, answer this question. Is there any recording for this, as I have missed the first hour? This has been asked.
It's recorded, sir. We'll be uploading it later. The DLS platform also, they can see the recording in due course time.
You can see it in the DLS platform. Is it okay?
And also, if not in login, we'll upload it in SIRC YouTube channel.
Okay. So I think, okay. Aging is mandatory for a non-corporate entity. Aging is mandatory. Aging, no, you have to give that only dues. No, that's all. Aging is only for this Companies Act. So don't do the aging for non-corporation. Will this Excel format be shared? Okay. Sir, in the Excel format, upload.
Sir, on the same dashboard, we'll upload it in presentation.
The format upload. Okay. Okay. So I think basically I have answered most of the questions. I will share this format also. If there are any further questions, you all can definitely, I can still take a few questions, but if you're not, you can, I will also leave you all with my details here, just in case you want it.
Yes, and they can contact them, because you have been with back-to-back sessions since morning.
Okay. Morning, 9 o'clock. Also, I thought I'll show you all this. I don't know whether PowerPoint is there.
Sir, Excel, PowerPoint change. Stop. Model financial statement. Yeah.
So what you can also do as a matter of this thing is that you can look at this given by the WIRC. This is available on the WIRC website, Western Regional Council. They've given you a format for non-corporate entries. Please go through this also. Again, I'll just sign off by telling all this as a very general thing, that you will have material from two different places like WIRC. But again, there are common points, not the same thing. There are common points here. Use any format which is comfortable for you. You don't have to follow this 100%, the technical 100%. That's what I'm trying to say here. What is comfortable, you'll please use. But I am looking at a situation wherein maybe in about 3-4 years' time, this is going to become mandatory, and we have to be prepared for that event. We have to be prepared for that day. That's why I'm trying to say that you can probably start now and do this as a general thing. Okay. So this is my presentation. These are my details. Any details required, I'll be happy to take those questions. So please send me a requirement. I will definitely answer all those questions. This presentation and the Excel sheet, both I will share with the SIRC. Selva will definitely upload on the.
Yes, sir. I'll definitely upload it on the.
Thank you very much. Thank you, Selva. Thanks a lot.
Thank you so much for time spent on behalf of SIRC, Chairman, Secretary, and Office for your continuous support to SIRC. I think it's nearly 3rd or 4th session in this year, sir. Actually, you've been taking up 4th session, sir, in this year. Actually, thank you for your continuous support to SIRC, sir.
Thanks, Selva. Thanks a lot.
Thank you.
Right.